Okay, so this is the 2007 company final accounts question 1, and I'm going to do part 5 and part 7. So part 5 first of all is, where are we, part 5. During 2006, a storeroom which cost 40,000 and stock which cost 12,000 were destroyed by a fire. Okay, new store was built by the firm's own workers, cost of their labour 19,000 had been treated as an expense, and the materials were taken from the firm's stocks. The insurance company has agreed to contribute 52,000 in compensation for the fire damage. Okay, so I think what I'll do is, since this is quite a big one, I'll break this. I'll do part 5 in one video and part 7 in a separate video. So part 5, first of all, I suppose to explain, instead of doing T accounts or anything like that, what I'm going to do is I'm going to just note what items need to be adjusted, and I'm just going to separate the items into top of the balance sheet and bottom of the balance sheet / profit and loss, because anything in the profit and loss that goes into the profit and loss has an effect on the bottom of the balance sheet, because you're ultimately taking the profit figure from the bottom of the profit and loss and putting it into the bottom of the balance sheet. Okay, so let's see what we have first. Number 5, a storeroom which costs that and stock which costs that were destroyed by a fire. So immediately I'm going to say storeroom is part of your buildings and it was destroyed, 40,000. So your buildings go down by 40,000. So that's the top of the balance sheet, isn't it? So buildings minus 40,000. That's the first thing. And then the stock, I suppose, is the unusual one. Then stock was destroyed by the fire. So we don't adjust our closing stock figure because it says during the year the stock was destroyed. So it means when you did a stock take to count your stock at the end of the year, that stock was already gone. It was destroyed. So it hasn't been included in your closing stock. So you don't need to remove it from your closing stock. Now, what does need to change, though, is you need to reduce your purchases by 12,000 because that's no longer stock that was purchased for resale. That's stock that you can't resell, really. So your purchases, which is in the profit and loss, purchases minus 12,000 for that stock that was destroyed. Okay, so that's the first part done. The next part, it says a new store was built by the firm's own workers. The cost of their labour was 19,000 and it had been treated as a business expense, and the materials cost 51,000 was taken from the firm's stocks. So 19,000 and 51,000 is what it costs to build it in terms of labour and materials. So altogether, your buildings is going to go up by 19,000 and by 51,000. If you like, the value or the cost of the new building, the new storeroom, is altogether 70,000. Is it 19 plus 51? It's 70,000. So your buildings should be going up by 70,000. Okay. The next thing is when you buy a new building, that doesn't go, or any fixed asset, that shouldn't be entered into the profit and loss account. So when you paid for labour to purchase, or if you like to acquire the new building, when you spent this money in acquiring the new building, that shouldn't be in as a business expense in the profit and loss account. So we assume that 19,000 is included in your, where is it, salaries and general expenses here, but it shouldn't have been because it's part of the cost of a fixed asset. So your salaries over here goes down by 19,000 because that should never have been treated as a business expense. It should have been treated as the purchase of a fixed asset. Furthermore, materials costing 51,000 were taken from the firm's stocks. Well, if they're taken from the firm's stocks during the year, again, that means we don't need to adjust the closing stock figure, because when the stock take was done and the stock was counted, that stock was already taken away, so we don't have to remove it from our closing stock figure. However, that 51,000 was included in purchases because we'll assume we did originally purchase it for resale, but then when we took it for a different purpose, it should no longer be included in your cost of sales, so you must subtract it from the purchases. Next thing then is, where are we? The insurance company has agreed to contribute 52,000 in compensation for the fire damage. No adjustment has been made. Okay, so the insurance company has said they will pay 52,000. So obviously they haven't paid it yet, so they owe it to us. So up here, compensation due as an asset in the balance sheet, a current asset, we'll say, plus, what did they say, 52,000. And that's it for part 5. And just to have a look at everything there to see what way it's working. The top of the balance sheet in total is going to go, well, this is a minus 40 and a plus 70 is the same as a plus 30 altogether, isn't it? The buildings has gone up by 30,000 when you take these three figures into account. And this is another current asset going up by 52. So all told, the top of the balance sheet is going to be, the balance in the top of the balance sheet is going to be increased by 82,000. Okay, over here on this side, purchases going down by 12,000. Well, that's, and down by 51,000 altogether. That's down by what, 63,000, isn't it? 63,000. Well, if you reduce purchases, it means you reduce the cost of sales, which means you increase your gross profit and your net profit. So that's going to increase net profit. This minus 19,000 from your salaries, well, if you reduce an expense, it also increases your net profit. So all these three figures are going to increase your net profit. And if we add them together, 12 and 19 is 31 and 51 is 82,000. So it means your net profit is going up by 82,000, which means the bottom half of your balance sheet is also going to go up by 82,000. So everything's going to balance fine. Now, the one thing that might have been a slightly different here in another question that you might want to watch out for is, in this case, the compensation that the insurance company was paying you was, or said they will pay you, is 52,000. Now, that's exactly the same amount as the money that you've lost. Like, you lost a building worth 40 and you lost stock worth 12,000. So 40 and 12 is 52. So that's exactly the same. That's why there's no other entry here. But if the insurance company, for instance, had only said agreed to pay you 50,000, for instance, well, then this side wouldn't be the same as this side. And the extra thing then that would go in if they only agreed to pay you 50,000 would be, well, first of all, this would only be 80 over here. But on this side, then you'd have a loss on whatever it was, destruction of the storeroom or fire in the storeroom, 2,000, which would reduce this by 2,000, and then they'd both be plus 80 as well. So you'd have that extra bit if the compensation didn't match what you lost. Okay.